Hello there, welcome to the Open on BNN Bloomberg. Happy Monday, one and all. Shame about that hockey game. Let's get to the big stories we're bringing you from our newsroom. Loblaws says it will invest $2.4 billion in Canada. Plans include opening 70 new stores and the creation, the company says, of more than 9,000 jobs. The expansion includes new Shoppers Drug Mart pharmacies and discount grocery banners such as No Frills, along with renovations to nearly 200 existing stores. The company is also continuing construction of a large automated distribution centre in Ontario. The spending is part of a broader 5-year plan to invest $10 billion, the company says, in Canadian communities by 2030. We're watching shares in electricity generator Emera today. The Canadian company reported weaker than expected fourth quarter results, with adjusted profit missing analyst estimates. The shortfall was driven largely by underperformance in the company's Florida electric utility. Emera's Canadian electric utilities also saw a sharp drop in profit year over year. Merck is reorganizing its pharmaceutical business, creating a separate division focused on cancer drugs as it prepares for sales pressure later this decade. The company's blockbuster immunotherapy drug is set to lose U.S. patent protection in 2028. Merck says the move will help it sharpen its focus and support more than 20 upcoming drug launches, as it works to offset the expected decline in revenue for the popular drug. U.S. futures pointing downward right now amid turmoil over what to expect or what impact to expect from President Trump's threat to slap a 15% tariff on U.S. trading partners after his U.S. Supreme Court setback last week. Here's how the TSX closed on Friday. Despite the tariff to and fro, our benchmark index closed at a record high. And let's have a look at oil. There is a headline today that the US and Iran are at least talking about some kind of a settlement, but oil up. And let's have a look at gold, important barometer of investors' hunger for a haven right now. And you can see gold's had quite a run. Still down just over $3,000 from its record high, but not far short of $5,200. And the Canadian dollar is holding pretty steady after its rally this year, north of 73 cents US. And finally, Bitcoin. Bitcoin weakening. We are hearing voices warning that there's more pain ahead, including Nouriel Roubini last week, warning that there's no real value here. So we have U.S. President Donald Trump hiking America's global tariff rate to 15% after the U.S. Supreme Court struck down his sweeping global import levies on Friday. Our guest says there is a possibility the court decision will lead to a harsher Trump stance in the CUSMA, broad North American trade pact negotiations coming up this summer. We're joined by Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. Thank you very much indeed for joining us, Kyle. I know it's a fluid situation, but this may not bode well for the North American trade pact talks.
Yeah, I certainly think that, well, right now, what we still have with some of the drama on Friday, I would argue that it's not necessarily about the tariffs themselves. It's about the unpredictability of this administration and what that may mean for established trade deals, and whether it's Europe, trade deals with Asia, or the approaching renewal or renegotiation in the summer with Canada and Mexico. I think it'll lead to some harsher stances by the Trump administration. We've already seen him target pretty specific areas of the Canadian economy. The most recent news items were around Bombardier, or whether it's a bridge between Windsor and Detroit. I think it can be, something that can be a detractor for for the Canadian economy, more so than what we've already seen. But I think that there will be opportunities for those who are willing to be patient and take advantage of some of the near-term noise.
One earnings report investors are watching, to put it mildly, is Nvidia on Wednesday.
Yeah, Nvidia is, of course, 8%, I believe it is today, of the S&P. So that is obviously going to move the market one way or the other. The most recent deal was around the expanded partnership with Meta that was worth tens of billions of dollars and helped ease some of the concerns around competitors eating into the market share of Nvidia. One way or the other, I think it could be more so less about the earnings that are actually posted and more so about the management commentary and evidence of spending from other companies around Nvidia's products. Salesforce is the other one that reports on Wednesday that I'm watching for insight around the software trade, and we've seen the volatility there the past few weeks and how that's developing.
Maybe we can put up a one-year chart for CRM. It is interesting. We just looked at Nvidia's chart. It is down from its high, but it's been pretty stable over the past few weeks.
It has. What I mean, it's kind of the juggernaut of the market. One of the things that I've been advising clients is the fact that in 2026, or maybe it's 2027, who knows, is that the headline returns are becoming less and less applicable to what the reality is of what's going on in the market. We've been entering a scenario where, given all the concentration, particularly in the US market, Nvidia being one of the primary components of that, if the top 10 companies in that index stumble or struggle and produce negative returns, but the other 490 stocks are doing okay or pushing higher, we could still see negative headline numbers. So I think that's something that people need to be aware of. And it's another reason why we've been very active and very select with the investments that we're making as we enter and get deeper into 2026.
We're looking at Salesforce. That's been a horrible stock to own over the past year, down 40%. And it is one of the most prominent software names to have been hurt by AI fears.
The software story is interesting to me, and I do think that there's an opportunity there. We've certainly benefited this year pretty heavily from the rotation away from software and some of the mega cap tech stocks. And as valuations have come down and the stock prices have come down, we've been looking at some select opportunities in the software space. I think that the longer term risks are certainly real, but the speed of the drop is assuming too much disruption in the near term. You even have a lot of these AI driven companies that are saying that software will still be a primary component of what they're creating. And I think in the case of some of the larger companies, whether it's Microsoft, Google, those companies are so large. They have such a large and vast access to capital. We've seen the debt raising that's been going on. They almost have this opportunity where they could potentially grow out of that disruption by just acquiring what they need, what they think is a complementary acquisition to their business and can help them trend in the right direction. So I do think that is something that there's a little bit of silliness going on, and that's something that people should be looking at.
You have some stock ideas for us. Start off with Intact Financial, massive grip on the Canadian insurance market.
Yeah, Intact is the latest addition to our mandate, so I wanted to highlight it. Of course, they're the largest provider of auto, home, and business insurance in Canada. They're a market leader in several provinces, but they also have specialty insurance offerings in the US, UK, Ireland, and in Europe. They had a really great Q4 earnings reports, beat estimates by 17%. Operating return on equity was almost 20%, which is the highest it's been since 2021. And we think that Intact is entering this new normal and capitalizing on a strong underlying profitability trend. Seeing progress on their US segments, UK and Ireland was improving. Canada, they're showing some great retention. What I think could be a catalyst for this stock is investors waking up to the fact that they've got a really strong track record of delivering earnings per share growth of around 10% and outperforming competitors. And their debt to capital ratio is about 16% today. Why I bring that up is I think it puts them in a good position to acquire additional share buybacks, as well as potential for acquisitions in the US and in Europe to help grow those revenues. They highlighted in their Q4 earnings that they they bought back about 200,000 common shares in those 3 months. And since quarter end into 2026, they've bought back an additional 70,000 already. So clearly management is seeing some opportunity at current levels.
We're tight for time, but 5N Plus is a stock that's drawing your attention as well. You like the look of this one?
Well, 5N is something that actually was on the show back in June, and I highlighted, and it's been a great addition for us. And they're based in Montreal. They're a leading producer of specialty semiconductors and performance materials. And an example of that is a highly specialized product integral in satellite launches. And the national security emphasis from the U.S. has been really favorable for them. There was news in January that the U.S. is investing to expand a germanium production facility in Utah. And that's something that I think the near-term benefits will be limited, but the longer-term potential is considerable and speaks to 5N's efforts to entrench themselves in the U.S. market and capitalize on the national security mantra that's really not going away.
Kyle, thanks very much indeed. Kyle Tyler, Wealth Advisor and Portfolio Manager at TriDelta Private Wealth. Coming up, we'll get an update on the situation in Puerto Vallarta, Mexico, after the government killed a cartel leader, and that triggered blockades, flight cancellations, and travel warnings, and also a shelter-in-place order across Jalisco state. We'll be right back. Violence erupted yesterday in Puerto Vallarta, Mexico, a popular vacation spot for Canadians. Lots of Americans retire there. A military operation against the Jalisco New Generation cartel killed its boss, known as El Mencho. It decapitated Mexico's most powerful drug cartel. Chaos ensued in large swathes of the country, with shootouts between government forces and cartel fighters. Let's get more from CTV's Scott Hurst. Scott, it's very dangerous right now, apparently, in parts of Mexico. What's the latest in particular on the impact on tourist destinations?
Good morning, Andrew. Lots of concern because of the outbreak of violence and the military operation that killed that drug kingpin, and then, of course, the retaliation by the cartel. Lots of concern about how it's impacting residents and tourists alike, as Puerto Vallarta is one of the more popular destinations in Mexico for Canadian tourists, not just during popular school holidays like we just had the Family Day weekend, and, of course, there is March break coming up in a couple weeks, but many Canadians go down there for extended period of time to get away from our winters and enjoy the sunshine and beaches in Mexico. But right now they are caught in a significant amount of violence as this popular Mexican beach destination is on edge. The violence triggered by this military operation that you mentioned against one of Mexico's fastest growing criminal networks, the Jalisco New Generation cartel. Mexican forces killing its leader, the man known as El Mencho, during a shootout as the military attempted to capture him. Cartel members then responded viciously and violently, creating a chain reaction with even more violence sweeping across the state of Jalisco to block military operations. We did hear from Mexican President Claudia Sheinbaum this morning, who said all the roadblocks have been cleared and is trying to urge calm, saying authorities are doing their best to ensure that residents and tourists alike are kept safe throughout this military operation and the retaliation, Andrew, from the cartel members.
Lots of travelers, though, stranded right now, including many Canadians. What's the advice for Canadians?
The advice for Canadians and other travelers alike is to shelter in place. And the advice coming from the Global Affairs Canada is to keep a low profile, limit your movements, and listen to local authorities about the possibility of trying to move about the city, about the region, and potentially trying to get to the airport. Global Affairs has updated its travel advice to Mexico to exercise a high degree of caution with added regional advisories that include Jalisco and Puerto Vallarta because of the security situation and the outbreak of violence. It is difficult for Canadians to get out, to get home, because Air Canada, WestJet, Canadian Airlines have canceled all flights to and from Puerto Vallarta as this violence has erupted, trying to work with customers on other options. But of course, the security situation takes precedent because it is so pressing and so volatile right now, and the fear is that it could continue. Foreign Affairs Minister Anita Anand says the Canadian government is watching the situation closely. We're expecting to hear from her later this morning in the 10 o'clock hour, so hopefully at that point we can get more information on what this means for Canadians, the advice for Canadians, and the attempt for so many of them to leave Mexico and get back here safely, so that they're not caught up in this ongoing violence between the Mexican government and cartels, Andrew.
Scott, thank you very much indeed.
Thank you.
Scott Hurst of CTV News. Up next, we'll get a lay of the land on the tariff front. We'll drill into where things stand after Trump raised his global import levy from 10% to 15%. U.S. President Donald Trump says he's increasing his global import levy to 15% from the previous 10%. And this time, he's using Section 122 of the 1974 Trade Act. It allows the president to slap on tariffs like this if America has a severe balance of payments problem. He could do it without congressional approval for 5 months. Let's get more from Derek Duclos, executive editor at Bloomberg News Canada. Derek, from what I'm seeing, economists and other commentators say America doesn't actually have a severe balance of payments problem.
Well, that's certainly the analysis that some are saying, and that would suggest to you that this latest move to put these 15% tariffs on might also come under a legal challenge. But there's another aspect of that law, which is that the 15% tariff, which is the maximum level that he can under Section 122, can also only be imposed for 150 days. So suddenly, it's not quite as threatening a lever for Trump to threaten other countries, to try to bully other trading partners into other deals, because it's not long lasting. Now, of course, the administration has other tools, so-called Section 232, which is what the steel and aluminum tariffs are already under, for example. There's another section called Section 301 that they intend to employ that may be more durable tariffs. So this is far from over, but it's certainly an interesting that the Section 122 is not quite as powerful a tool.
I know we're still drilling into this, but is there an impact on Canada here? From what I saw late last week, it didn't look like we would face a much bigger tariff burden.
No, I mean, the real key there on Friday, after he announced the 10% levy that he then on Saturday raised to 15%, is when they came out on Friday night with the executive order. It included the exemption for USMCA, for most things that are shipped under USMCA. Obviously, that doesn't apply to steel and aluminum and lumber and some of the other things that are separately tariffed. But the long and the short of it for Canada is that this modestly makes the Canadian position better. Doesn't change it very much. That's true of Mexico as well. So unless they take that exemption away, which Trump has so far been very reluctant to do for a whole bunch of reasons, this 15% doesn't seem to change the Canadian position very much.
And I think you touched on this, the administration insisting it has other tools, and the U.S. Treasury Secretary saying, yeah, this is just a bridge measure until we get other import barriers or import duties in place.
That's right. I mean, Section 232, which is the one that they've been using on sectoral tariffs, that's the tool that really has, up to this point, affected Canada the most. And it's one that they keep going back to the well on. Because remember, beyond the metals and beyond automobiles and beyond lumber, there's a bunch of other investigations out there. I mean, they have used this part of the Trade Act for like furniture and things like that. So in theory, this could come to quite wide application, but it takes an investigation first, I believe, by the Commerce Department. So there are some caveats to it. They can't necessarily do 232 tariffs right away. And then you're going to get into a situation later this year where the midterms are going to start to matter, and the math of inflation in the U.S. is going to start to politically matter a lot more.
Derek, thank you very much indeed. Derek DeCloet, executive editor for Bloomberg News, Canada. Up next, let's check out U.S. futures as we count down to the opening bells. We do have, okay, that's going to be after the break. Okay, you can see stocks down. We'll have plenty more coming up on the open after this. Let's take another look at U.S. futures as we count down to those opening bells. And you can see stocks under pressure. There was a pretty muted reaction Friday to Trump's setback. Supreme Court throwing out some of his levies, the ones that he had administered on global imports. Canada, as Derek DeCloet of Bloomberg just reminded, not really in the crosshairs on this one, although the president turned around and imposed a 15% levy on imports, citing a balance of payments crisis, which has been met with some skepticism. Let's have a look at B2 Gold, how it traded Friday, which was a major change at B2 Gold. Clive Johnson, one of the great characters in Canadian mining, is stepping down. Now, the stock has been under a little pressure lately. Obviously, it has doubled in the past year, but a lot of gold stocks have done better than that. They've had ramp-up problems at their Goose mine in Nunavut. So Mike Cinnamond has been named as chief executive officer, and Clive Johnson is retiring, and he's been in that role since he set up the company in 2007. Cinnamon takes over June 4th, and then Johnson becomes chair emeritus, remaining actively involved with the board and senior management team. Clive, not one to sit back. So he's been there for a long time. Cinnamon has been chief financial officer at B2 Gold since 2014. And another stock we're watching, not sure if we can pop it up there, Emera. The company coming in, TD says, with profit 55 cents a share in Q4, modestly below our forecast and consensus of 58 cents. So there was weakness in the electric utilities in Florida and Nova Scotia. So that stock might see some selling today, but you can see it's surged 25% in the past year. Right after this, we'll bring you those opening bells. Oh, there we go. And we are there. So at the NASDAQ, it's the Association of African American Financial Advisors bringing the opening bell. At the New York Stock Exchange, it's construction industry leaders beginning the countdown to ConExpo, a construction exposition. It is time for the first 15. And let's see how stocks are beginning the trade this Monday morning. TSX, remember, closed at a record high on Friday despite tariff uncertainty, and it's pushing further into record territory right now. We have seen strength in gold, not far short of 5,200, and that's probably going to be good for Toronto. You can see Toronto stocks on course at this rate to breach 34,000 for the first time. U.S. stocks down, but very, very slightly. Looked like the market wasn't too disconcerted about Trump's tariff setback and his threat then to up the ante, go to a 15% global import levy. Just looking at active traders in Toronto. We'll bring you more detail on that, but I'm sure the golds will be helping the market today. Couple of stocks on our radar. Let's have a very quick look at Emera once again. The market doesn't seem too worried. It wasn't a massive miss on Emera on the expectation. Let's have a quick look at Superior Plus, because that stock has been suffering. They've had setbacks on earnings, and they're a diversified player. Propane is a big part of their business, but also they got into renewable fuel in the United States, and it's been a little heavier going there than they thought. Scotia downgrading that stock to a hold after a 20% sell-off on Friday. That seems fair, Scotia says, and we're moving to the sidelines on greater uncertainty than risk. Yeah, the big problem here, that's Certarus renewable fuel business, Scotia says, in the States. We don't know how low the prices and margins can fall on increased competition. Let's check out some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, thanks very much indeed for joining us. Pressure on Novo Nordisk?
Yes, big pressure. The stock was down as much as 17% earlier today. Worth watching here as, big drop. So worth watching here over the course of the day as well. It's worth watching some of the competitors to Novo Nordisk, including Eli Lilly. What happened overnight is that Novo put out some data for its next generation obesity shot drug, and the data was a big disappointment, especially relative to those competitors. So, look at that, 15% in the regular trading session here for Novo. Big drop. This, as Bloomberg Intelligence put it, is the worst case scenario for this obesity shot. And it is really having an impact so far this morning. JP Morgan was also out calling it a significant negative. The next gen obesity shot is something that has been looked to as a catalyst for a number of these drug companies in the space. Now Novo has to look ahead to the next, potentially the next iteration, which might not be till 2029, 2030, according to some of the research that we've seen so far today. So big drop. A handful of suppliers and kind of peer companies in Europe to Novo are falling today as well. Worth watching, as I said, some of those competitors and peers in the U.S., including Eli Lilly. And
you're also watching a company called, hang on, okay, let's move on to Deere. I'm sorry about that.
Deere.
Deere down.
No, all good.
Jeffrey's cutting this one to a sell.
That's right, to underperform. The Deere, we talked about it last week. It was up sharply because of this expectation that the cyclical low for agricultural stocks was going to be in 2026. There was a lot of potentially optimistic views from the CEO. Jeffries does not share that this morning, downgrading the stock. The stock is falling as a result. And what they're saying is two things. One is the cyclical lows in the agriculture sector tend to be more drawn out than what the market is currently pricing in. Also, this stock is up 42% on the year. So Deere has had a good year so far, despite the negative outlook for agriculture. And you have now what this analyst thinks is you have the recovery that's already priced in. So meanwhile, there's still a handful of problems in the agriculture business. Farm economics are considered weak. According to Jeffries, input costs are still high. Trade volatility is still weighing on weighing on farms. Farms also have a very high level of debt to assets. So the debt to asset ratios are a problem, which makes it more difficult to go out and buy new equipment.
Jeff, thank you very much indeed. Jeff Morgan of Bloomberg.
Coming
up, U.S. President Donald Trump vows to bring back tariffs after one set of levies were struck down by the Supreme Court. What does it mean for the markets? We'll have more after the break. So the tariff to and fro continues. U.S. President Donald Trump getting a setback in the Supreme Court last week, but vowing to go ahead with a 15% levy on imports into the United States on many of the country's global trade partners. Let's get more now from Nate Tooft. He is Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. Nate, thanks very much. You reckon that really the tariff story has exhausted itself with investors. And anyway, a lot of the impact is now behind us.
Yeah, I think that's fair, Andrew. It's great to be here. From our perspective, there's two reasons why the market is kind of looking at this and saying, oh, well, we're not seeing a lot of major downside. We're not seeing a lot of major upside. But there's two reasons for that. One is the fact that the markets are a bit exhausted from the topic. This has been going on for well over a year at this stage, and it's just a constant battle, right? But the second and probably the most important aspect of it is the tariff levels that we're seeing are actually lower than the peak levels that they were talked about at some point in time during the course of last year. And even with the recent Supreme Court announcement and the possibility of renegotiating or implementing the additional 15%, the tariff level that will actually be priced into the market is lower than what we came into the year. And so we are looking at an environment where, generally speaking, the worst of the pricing of tariffs happened last year and is unlikely to be the case this year. And I think that's what the market is looking through to say, hey, we've seen the worst case scenario. We're not revisiting those high levels of ultimate tariff levels.
Nvidia, you think, will be a bigger deal when it reports on Wednesday?
I think earnings is probably the biggest story of the week, to be honest with you. There's a number of earnings reports. Nvidia, in particular, obviously the biggest company in the world, representing in the neighborhood of 5% of the global equity market, is a massive indicator of what the CapEx cycle looks for, like AI. And expectations are really high. We're talking about 70+% earnings growth year over year. That's a big number. So they have lofty expectations. But let's keep in mind, Nvidia has a history of beating those expectations, and their outlook will be very key as it pertains to, can they keep that earnings growth and that level of earnings growth over the coming 12 months?
Let's pop up TLT, a US ETF that tracks longer-term bonds. You say around the world we are seeing investors more reluctant to hold longer-term government debt?
Yeah, I think it's a challenge with the fixed income markets in general. We have an environment where we know central banks are going to be accommodative, and we're likely to see more accommodation by things like the Fed lowering rates at a couple quarter points this year. We have other central banks lowering rates, but that really only impacts the short end of the yield curve, as in bonds that are due over the next couple of years. But when you look at the longer end of the yield curve, there's greater concerns about longer run inflation levels. There's greater concerns about fiscal spending and debt levels. And so we do think there's going to be a steepening of the yield curve, which means the longer end of the yield curve doesn't come down as much as the short end of the yield curve. And from our perspective, this means investors should generally focus their fixed income portfolio on the shorter end of the yield curve, particularly what we call the belly and inward, kind of the middle of the yield curve to the shorter end, without going out too far to get to longer duration fixed income assets.
Essentially, just turning to stocks broadly, you see steady U.S. profit growth as supporting the equity markets?
This is the biggest tailwind in the markets right now. We still believe this year will publish, despite all the geopolitical risks. And let's be honest, there's no shortage of them. We have the Iran situation, we have tariffs, we have other geopolitical dynamics throughout the globe. But when you look at underlying earnings potential this year, we are very likely to see earnings growth in excess of 10% year over year in most geographies across the globe. And this includes geographies that haven't done as well from an earnings perspective over the last, let's say, 5 or so years, such as the emerging markets, which could easily potentially publish earnings growth of 15 to 20% year-over-year growth from an underlying emerging markets index perspective. So we're seeing a pretty broad array of both countries, sectors, and companies participating in upside when it comes to earnings growth in 2026. And that is the biggest potential tailwind to overall equity markets for the remainder of this year.
How are you guys, you and your colleagues, handling energy right now, in particular oil and gas?
This is the one area of the geopolitical dynamics that we do have some concern about. And what do I mean by that? Generally speaking, when you have these geopolitical dynamics happening, markets look through them pretty quickly and say, hey, this doesn't really impact the markets overall too much. But when you have something like Iran and you have a situation where oil and the impact of supply of oil can be impacted, that's a bit more problematic. And right now we're starting to price in some what we call risk premium into the oil markets, which is the rise you've seen over the last month or so. But there is a potential, particularly if supply is cut off further, oil prices could go up even more. And that's a risk we have to think through, particularly as it pertains what's that flow through to overall inflation levels and what's that flow through to sentiment for the broader equity market. So that's the one area, in addition to the broader metals complex, precious metals, that we believe are the two focal areas for geopolitical risk this year.
Meaning that you're overweighting them, or?
We like them a little bit more than we did. And in particular, if you look at the metal side of things, gold and silver, we still like that trade. We think that geopolitical uncertainty puts a bit of a floor on and potential upside pressure on things like gold and silver, as an example. When it comes to oil, we think it's a shorter term phenomenon. We could get a repricing, let's say another $10 potentially, if we continue to see uncertainty, particularly around Iran and the oil supply. And that could provide upside for both energy commodities as well as the stocks that traffic in that area. And so in the short term, we like energy stocks, and in the longer term bias, we like gold and silver related assets.
And sorry, we've only about a minute. Why are you still fairly optimistic about gold prices? I mean, do you see them going higher from here?
We actually do, believe it or not. I think there's a couple drivers behind that. When you look at the pillars that drive gold prices, everything from inflation uncertainty, geopolitical concerns, debasement of fiat currencies, things like that, those are all still flashing green in our view. So generally speaking, the drivers that have driven gold to the levels that we're already at, they're continuing to be in place. And so we do believe there's still a lot of technical and sentiment and even fundamental drivers that could continue to keep a very strong bid under the price of gold throughout 2026 and beyond potentially.
Nate, thanks very much indeed.
Thank you.
Nate Tuft, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. On Friday on Market Call, we were joined by Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners, Raymond James. She was covering Canadian and US large caps, and her top picks were ATS, NRG Energy, that's NRG in New York, and Netflix. Today on the show, it is Jerome Haas, always worth listening to, Portfolio Manager at Lightwater Partners. He'll be taking your questions on Canadian stocks. Just ahead, a look at a couple of today's notable calls, including Devon Energy. Let's check out a few notable calls today. Scotiabank analyst Paul Cheng is cutting the firm's price target on Devon Energy, the U.S. energy producer, to $41 US from $45, and sticking with the sector perform rating, a hold verdict on the stock. The firm expects that Q4 results will have a neutral impact on the shares in the near term. The analyst says that Scotiabank thinks the risk-reward is fairly balanced. Also says Devon will need to demonstrate sustained outperformance to ease market worries over its Delaware and inventory backlog. And let's stick with U.S. energy names here. The price target on Occidental Energy are raised to $54 US from $48 at TD Cowen. So it's going up, but the hold rating remains on the shares. TD Cowen says that now that deleveraging is in the rearview mirror, Oxy has highlighted little to no appetite for mergers and acquisitions, and it is focused on execution ahead. The company has been making progress on efficiency. And RBC is actually cutting Imperial Oil to underperform, to a sell. Saying, sure, we still like the stock, a solid leadership team, long life, low decline assets, but the relative outperformance and the valuation seems to have disconnected from the fundamentals. Look at that run, and they see better returns potentially elsewhere. Now, I think we've seen at least one other downgrade of Imperial Oil lately because of that huge move up in the stocks. It's an Exxon subsidiary, obviously. The street is not keen on these shares, but people keep buying them. According to my Bloomberg screen, there's only one buy, 7 holds, and 11 sells now on Imperial Oil. Let me just see what the dividend yield is. Usually this one's a pretty substantial dividend yielder, 2.2%. And Yep, RBC saying the relative valuation appears stretched. Stock has earned itself a premium valuation. Okay, so our Imperial Oil, too rich for lots of analysts right now. Coming up, what to expect from Nvidia. The world's most valuable company will be back in focus this week. The AI juggernaut Nvidia reports earnings on Wednesday. And of course, these results could have an effect on the broader mood around artificial intelligence and the boom in that sector. Let's get a preview now from BNN Bloomberg contributor John Ehrlichman. John hosts the investing channel Ticker Take on YouTube. John, remind us, thanks for joining us. What are the expectations for Nvidia?
Yeah, well, and to your point, Andy, I think there's two levels of expectations. There's the question about, all the classic, can they meet the numbers, beat the numbers, all that kind of stuff. And I'll remind our audience that Nvidia has a pretty good track record over the last decade of putting up earnings that were better than expected. And generally, the stock has trended well, according to Bloomberg data, in the days after earnings because they've had that strong track record. But I think what you're getting to is the broader mood around AI, and you can see that somewhat reflected in Nvidia's stock, still holding most of its gains, but kind of meandering in recent months. And of course, we've seen a pretty sizable rotation away from, call it the Magnificent Seven stocks, into other parts of the market. And, Jensen Huang, the co-founder and leader of this company, has a history of being the voice that everybody listens to, so much so that, he hasn't only created excitement in the AI story, but in like the quantum computing world as well. So, as the tech evangelist, it does seem like people are going to look for two things. Number one, just what he says about how predictable their revenue is going to be going forward. Mm-hmm. And number two, any more he might say on the state of the industry after the recent pullback in some tech names.
I guess one cloud over the company is OpenAI. People wondering, can they keep up with their huge spending plans when revenue is still only growing?
I think that's a good point, Andy. And sort of this complicated relationship that companies like Nvidia and OpenAI have, just to back up a sec, you've got other companies like the parent of Google, Alphabet, mm-hmm. that have been busy developing their own, for lack of a better word, AI chips that can compete with the NVIDIA product and can fuel Alphabet's own Gen AI ambitions, things like Gemini. And so there's been a lot of focus on NVIDIA's investment into OpenAI and whether that's sort of like a circular thing. You've got some bears that have been calling that into question. I think what you can't call into question, though, is because we are headed towards more integration of AI, that NVIDIA's business is extremely profitable. I'll just give you a quick context piece here, Andy. A decade ago, for the full year, NVIDIA generated less than $1 billion in net income. With these fiscal 2026 numbers that will be fully reported this week, they're expected to have seen, according to Bloomberg data, $115 billion in net income in the last 12 months. And for those analysts that are brave enough to forecast out another 5 years, I've only seen a couple, but they're predicting the bottom line net income story for NVIDIA will reach $300 billion. And that's one of the reasons when the analysts or money managers tend to call this a cheap stock, it's because despite the huge move in the shares, the fact that the profits have risen so dramatically means that you've still got actually a name here that, based on traditional valuation metrics, is trading below its average over the last few years. So, whether NVIDIA is now looked at as a value stock, I think depends on whether or not people think that the best days of growth are behind it. But that seems a little premature to make that kind of comment.
John, thank you very much indeed. Really appreciate it. John Ehrlichman, John hosts the investing channel Ticker Take on YouTube. We have lots more ahead on the show. Let's check in very quickly on the equity markets. TSX pushing further into record territory. helped by gold stocks once again. We have seen, let me just check on the spot gold price, but we've seen stocks like Fortuna Mining jumping today. We've also seen Silver Corp moving up, and Kinross Gold higher. Wow, Kinross up around 5%. And just looking at the spot price of gold, it is just shy of 5,200 right now, but moving higher, up almost $100 today. And there's the look at the April futures. You can see they're up almost $140. The spot price of gold, so it's about 5,200 right now, is still down from its record high on January 28th of just north of $5,400. Some other stocks of interest here. Let's have a look at some shares that are under pressure. Athabasca Oil down. Vizsla Silver, of course, they had that awful situation in Mexico where workers were kidnapped and murdered. Aritzia also down. Let me just check. That has been something of an investor darling. I'm just seeing if there's been any reason for that sell-off. Well, here's the headline on Bloomberg Intelligence. Apparel retailers win some tariff relief with this Supreme Court ruling, but I guess that's still a worry hanging over the market. And the company actually acquiring the Fred Siegel brand as it accelerates its push into the United States. Okay, I think we're out of time, but we've got lots more ahead. Our guest says markets may well be headed for turbulence as investors digest softer U.S. economic data. Welcome to the second hour of The Open. Here are the big stories we're bringing you from our newsroom. Loblaws says it will invest $2.4 billion in Canada this year. That includes plans to open 70 new stores. And the company says it will create more than 9,000 jobs. The expansion includes new Shoppers Drug Mart pharmacies and discount grocery stores such as No Frills. The company is also continuing construction of its big automated distribution centre in Caledon, Ontario, north of Toronto. The spending is part of the company's broader 5-year plan to invest $10 billion in Canada by the end of the decade. Shares in Emera now slipping about 1.5%. That Canadian-based electricity generator posted slightly weaker than expected fourth quarter results, with adjusted profit coming in below analyst forecasts. The results were weighed down by its Nova Scotia Power and New Mexico gas operations, as well as underperformance in its Florida utility unit. Emera's Canadian electric utilities saw a sharp drop in profit year over year. However, the company did beat expectations on revenue. Shares in Domino's Pizza up about 4%. The company posted fourth quarter revenue of $1.5 billion US, beating analyst estimates. In fact, the increase was about 6% from a year ago. U.S. same-store sales rose, with franchise locations outperforming company-owned stores. And let's have a look at the TSX, which once again is in record territory today. No stopping it, and once again, it's being boosted by gold. I'm just looking at the big traders right now in Toronto. Sun Life down slightly, but Enbridge higher. CN Rail higher, Kinross jumping more than $2. No clear, the golds are doing the job today. Barrick's up almost 3%. Agnico is up almost 4%. And B2 Gold up almost 6%. The company has been under pressure with a slower ramp-up than hoped for at its big Goose mine in Nunavut. But Clive Johnson, the longtime CEO, is going to be stepping down this summer and becoming chairman emeritus. And let's have a look now at the U.S. market as investors digest U.S. President Donald Trump's defiance on tariffs. He says he's going to charge a 15% levy on global imports on the alleged basis that the U.S. has a severe balance of payments problem, which some economists are dismissing. Looking at the winners and losers south of the border, Nvidia up 1.5%, Tesla down 2%, Microsoft down 2%. Those are the three big traders by value. Markets held up okay on Friday, even though U.S. GDP growth was weak, inflation persistent. Our guest says, though, that pressures are building with soft economic data, particularly south of the border, and uncertainty around tariffs. Let's get more from Ryan Bushell, CEO and Portfolio Manager at New Haven Asset Management. Ryan, thanks very much for joining us.
Thanks for having me, Andy.
Start off with the U.S. economy. I mean, we've heard that, it's doing fine. There's no signs of big cracks, but you say there are some clouds here?
Well, I was just sort of surprised on Friday to see, weaker than expected economic data, GDP coming in at half what the expectation was. Now, some of that was related to the government shutdown, but regardless, the fourth quarter blowout numbers we saw don't appear to be repeating themselves. And so that combined with a higher inflation number, that is a scary prospect for markets. A stagflationary scenario is something nobody wants to see. Then you combine in with the fact that the tariff ruling, we just got adjusted to these tariffs. Now they're, in theory, maybe being taken off. What does that do to the U.S. fiscal situation, or potentially even being ramped up now with what Donald Trump has done over the weekend, saying we're putting in a 15% tariff across the board. It started at 10, went to 15 before markets opened. So quickly changing circumstances is not something anybody in business wants to see, and that's what we've been dealing with for over a year. We just finally got to kind of a new normal, and now it's being shaken up again. So all of those things point to uncertainty for me. The other thing that's happening is oil prices are back on the rise, and so that flows through to the inflation side of things as well. So a lot of cross currents now to be keeping track of.
What is your broad strategy? Are there areas of the market that you're avoiding right now, Ryan, or underweighting?
Yeah, so anybody who understands the way we invest money knows that we are not tech investors. So as that has been under pressure in the last few months, our type of portfolio has benefited. We've seen money flowing broadly out of the U.S. to anywhere but, so the outperformance in emerging markets and other tertiary markets like Canada. And money seems to be flowing from, call it the digital space, the digital economy, back to the real economy. So tangible assets, utilities, infrastructure, pipelines, all of those companies, we've seen massive moves, which we're happy to see. We were investors in those when people were eschewing them. So nice for us to see that come back around our way. And, we think that this move could continue. Any sort of broader turmoil in markets, we still have huge concentration in technology. We still have higher multiples in technology. So any continued rebalancing of that or any market panic, we would think is likely to be concentrated in that area, to the benefit of tangible infrastructure assets like the ones we own.
Broadly, how are you playing the excitement over copper? Do you feel that's overplayed, Ryan, at this stage?
It's hard, right? And I would like to have more exposure to base metals. It's hard for us as a conservative dividend investor to find the right vehicle. You can buy the big miners, the BHPs, the Rios, but you're not getting sort of that pure exposure. And then on the smaller companies, as we've seen in places like Mexico and South America and Africa, there are risks geopolitically on securing that production. So I think the hype is somewhat overblown. You also have this factor of China's inventories and stockpiling and how much they're going to restrict output because they refine the bulk of the copper in the world. So a lot of cross currents in that space. We prefer, again, to own sort of the end use product, which is, again, it is going into utility-based infrastructure. It is going into electrification, construction, which we own a part of. So we're not directly in that space, but it is worth watching. And for those that are there in a big way, you're seeing, again, money flow from digital economy to real economy is benefiting base metals and obviously gold as well.
You have an interesting trade idea here. Brookfield Infrastructure trades as units, BIP.UN, and then Brookfield Renewable trades as BEP.UN. Now, the company, known for its convoluted structures, has also issued common shares that are the equivalent. I think part of it is to help some investors with tax planning. But you say that the units in both outfits are trading at a discount to the corporate shares?
Yeah, a material discount. So I was on January 20th, and I just went back to that date and looked at the moves in both the unit trust structures versus the corporate structures. Again, the corporate structures, BEPC, BIPC, which trade on both New York and Toronto, are there to service the institutional investing community that can't own a Bermuda-based limited partnership for governance reasons. So the way they got around that was to offer it in a corporate structure, which just is basically a fund that holds the units. So it's the exact same underlying assets, and those premiums for both the unit trusts, the corporate structures over the unit trusts had blown out in January, and Brookfield themselves came out with an at-the-market equity issuance program of the corporate units to buy the undervalued trust units. So as a Canadian investor, where you can buy those trust units, still get dividend treatment, the full treatment in your RSP or TFSA, where you don't have to worry about the different tax treatment in your taxable account. We think it's a very good trade. No, we're not in it for the trade. We just think for our clients, if we can buy the exact same company with a 0.75% higher yield, that's going to do us well over time, and we've seen that. So since January 20th, both unit trust structures have outperformed the corporate structures almost 2-to-1. So it's about 12.5 for the BEP units relative to the corporate units, up about 7, and about 11.5 for the BIPC units versus the corporate units, up about 6. So not bad for a month's performance.
And just finally, Telus raised eyebrows by appointing a former boss of CIBC as its new CEO. You welcome that move? You think it's plausible?
I think it's fantastic. When I heard that news, Rebecca and I were talking about it in the morning, and she said, "You'll never guess who the new CEO of Telus is." And I started thinking about different. I said, "Is it a telecom person?" She said, "No." I said, "Is it Victor Dodig?" And she said, "Yes." And I said, "Wow, that is best case scenario." Victor did an amazing job at CIBC, turned a bank around that really didn't have an identity, was struggling on the consumer side, and really brought a cultural shift to that bank and really good earnings performance. So that's all you want to see. Telus is in exactly the same position. Now, different set of circumstances, and not to disparage anything Darren Entwistle has done over his long tenure at Telus, but they were in need of a refresh. They were in need of a cultural shift, and they're in need of a leader that I think can bring this company forward into, a new set of circumstances for the telecom sector in Canada as the technology behind it changes as well. So I'm really positive on this move. I think they're very lucky. A lot of these former bank CEOs, usually they stay on the board and they're still active in companies, but for him to actually take on the CEO role and put his butt in the hot seat, I think that speaks volumes, and I'm very positive on people that can lead culture.
Thank you very much, Ryan. Ryan Bushell, CEO and Portfolio Manager at New Haven Asset Management. Coming up, our guest says markets may be headed for turbulence as investors look at economic data. We're going to have more after this. Passive investing has surged over the past few decades. Lots of investors have put money into ETFs that simply track the overall market. Lots of people, of course, have these investments that just automatically go into the market. And history shows that typically active managers have trouble keeping up with the broad market. Our guest, though, says that the high volume of passive investment changes the way markets behave and create a systemic risk that we're all exposed to. Let's get more from Michael Green, Chief Investment Strategist at Simplify Asset Management. Michael, it's great to see you. Thanks very much for joining us.
It's always a pleasure. Thank you for having me.
Now, we have heard about this for years, haven't we? That passive money goes into big stocks And that tends to push them up. And of course, they become market leaders and people think, oh, I'm just going to index as well. Do you think the risk is getting worse?
I think the risk is absolutely getting worse. Unfortunately, the entire theory behind passive investing is predicated on the idea that you never actually enter markets or exit markets. You only hold securities, almost reminiscent to the Bitcoin type hodling framework. The challenge is the minute you break that model and you recognize that these funds are receiving extraordinary inflows, the distortive impact of having an investor who is really just a systematic algorithm. Did you give me cash? If so, then buy. What should I buy? Everything in the index in proportion to its market capitalization. That ends up pushing the securities that are the largest and most volatile components of the index up disproportionately. That in turn means the next dollar in, which comes the very next day, or in the case of ETFs, sometimes the next minute, will actually push them even further in that same direction. It creates a momentum bias and it creates a size capitalization bias that we have seen play out in US markets for the past decade, and increasingly we're beginning to see around the globe.
Of course, Burton Malkiel's book, The Random Walk Down Wall Street, a Bible for many investors, and it does cite evidence that you're better off just in the index rather than trying to pick a skilled stock picker.
Well, this is, of course, one of the challenges, right? The theoretical framing of a random walk down Wall Street and the understanding of it. When Burton Malkiel wrote that paper, he actually identified that most individuals underperform due to the management fees associated with active management. We have seen those fees collapse. They're down about 80% from the time when Malkiel wrote that. The emphasis on reduced transactions, et cetera, was really critical in that era. And candidly, investors have benefited from the reduction of fees that passive investment has pushed through the industry. That is independent of the empirical reality, though, that market capitalization does not scale, or more accurately, liquidity does not scale with market capitalization. And so the bias that has been created in the market as we have grown passive from a very small fraction of the market in the early 1990s to today exceeding 50% by market capitalization in the US is driving valuations higher and causing stocks to behave in a more correlated fashion than we have ever seen before. Valuations being pushed to these levels lowers forward returns, but unfortunately, those forward returns fail to materialize as negative, as we've heard from many forecasters for the past decade, because the continued flow of passive elevates them even further. This has created a remarkable disconnect between the economic underpinnings and the actual performance of the securities that creates a systemic risk, one that can't really easily be diversified or hedged.
I mean, I can see it's a completely alien philosophy, isn't it? You buy stocks simply because they're a big part of the index. You almost don't care what the revenue and profits are.
You don't. You really, truly don't. And this actually helps to explain why markets have in many ways behaved like that famous episode of Seinfeld, the Costanza market. A rational, thoughtful investor will see price rise in the absence of a fundamental improvement. They will forecast forward. That means lower expected returns and reduce their emphasis on that security. A passive investment philosophy instead reinforces the momentum, simply assuming that everybody else has done the work, and that's why the price is rising. There is no consideration of a self-referential component to it. Unfortunately, we have very clear evidence that this is actually what is happening in markets, and it's creating many of the social ills that we experience as governments have biased investment for retirement purposes into passive vehicles, particularly those that are focused on large cap stocks. This is why we have struggles with IPOs. A passive benchmark cannot buy an IPO in advance. It cannot deviate from itself to participate in that IPO. Private equity is experiencing extraordinary inability to take companies public, even though valuations are at all-time highs. Why? Because, unfortunately, again, the passive index cannot deviate from the benchmark. This is creating many of the challenges that we're experiencing today, and unfortunately, it's leading both investors and policymakers astray.
I hadn't thought of that angle. I mean, we in Toronto are seeing just a denuding of our benchmark index because so many companies are being taken private. And I know in the States as well, there's been a significant drop in public companies.
It's been a combination of mergers, which for public companies are actually beneficial by increasing the scale of the company, raising its market capitalization relative to the overall universe through a stock merger. That ultimately improves its positioning within the index and contributes to forward outperformance. That's why we've seen the mergers happen in many cases. There also has been a failure to enforce antitrust, which is a related but separate issue. In terms of new IPOs, they just don't exist. We have run well below historical levels. It's not that new companies aren't being created or that there's not new interesting companies being created. It's just the ability to successfully take a company public is increasingly challenged.
I mean, I don't know if I can call it the doomsday scenario. Critics of passive investing have warned for years about a possible self-reinforcing cascade. The big stocks start underperforming, investors dump their index funds, and then the big stocks are sold in increasing amounts. But that has yet to come about.
Yeah, it absolutely is yet to come about. Our research suggests that somewhere in the 70 to 80% passive share range, we enter a self-critical regime in which it becomes volatility reinforced that ultimately that crash occurs. I don't think investors are going to change their behaviors for the very simple reason that, one, there is a liability protected style of investing for 401ks and IRAs where advisors are incentivized by our legal frameworks to push people into passive investments, regardless of their valuations. The second factor is, of course, the performance is enhanced by passive investing. My current work suggests that up to 15% a year of the gains of the S&P 500 can now be attributed to the growth of passive investing in the markets. That's really all the returns that we're getting at this point. But as passive share grows, that could actually accelerate before that volatility event occurs.
Michael, we'll have to leave it there. Always great hearing from you, and thanks.
Thank you for having me.
Michael Green, Chief Investment Strategist at Simplify Asset Management. Up next, we'll tell you about the fight over the Reese's Peanut Butter Cup. Let's get to the candy clash playing out at Hershey's, and it has to do with the beloved Reese's Peanut Butter Cups. ABC's Rebecca Jarvis has the story.
It's one of the sweetest combos in candy history.
Real milk chocolate, old-fashioned peanut butter.
Reese's Peanut Butter Cup.
But that was then. Now?
We're making a big change to Reese's Peanut Butter Cups.
A swirling controversy that's turned quite salty, a twist even E.T. couldn't have predicted.
Nasty. It was disgusting.
Brad Reese, the grandson of the inventor of the Reese's Peanut Butter Cup, recently discovering ingredient changes in some Hershey's Reese's products. It started when his Valentine's Reese's Mini Hearts Unwrapped tasted off.
I took a couple bitefuls and I was like, ew.
Brad, shocked to find the ingredients listed chocolate candy and peanut butter creme, as opposed to the original recipes, milk chocolate and peanut butter.
I've been around Reese's my whole life. I never thought I had to look at the package to see what I was getting.
Brad taking his disappointment public with an open letter to Hershey's leadership, writing in part, "My grandfather built Reese's on a simple, enduring architecture, milk chocolate plus peanut butter, a real, tangible product identity that consumers have trusted for a century." The Hershey Company responding in part, "When developing new product lines, we've made some recipe adjustments to allow us to make new shapes, sizes, and innovations that Reese's fans have come to love and ask for." The company adding that the Reese's Peanut Butter Cups are still made the same way.
I like that. So they took out the chocolate and they put in chocolate candy. It's chocolatey, let's say, not chocolate. Let's have a look at Reese's Hershey's stock over the past year. Doing pretty well, up 29%, according to Barclays. The company reported in early February a strong top and bottom line, although the scanner trends had indicated that they were going to do okay, and they're hoping for organic sales growth this year, aka excluding acquisitions, of up to 3.5%. So that's stock up 29%. Let's have a look at Mondelez, the parent of Cadbury and innumerable other consumer brands. Mondelez International, you can see Hershey has been blowing them away over the past while. But that's interesting. Yeah, check the ingredients. Coming up, Canadian banks beginning to report earnings this week. We'll get a preview. There's a look at Loblaws stock today. Wow, the stock has surged almost 60% in the past year. The company says it will invest $2.4 billion in Canada this year. Plans include new Shoppers Drug Mart pharmacies and discount grocery banners such as No Frills. And the company is pushing ahead with its big robot distribution centre in Ontario, in Caledon, north of Toronto. Loblaws says the spending will create 9,000 new jobs and is part of a broader 5-year plan to invest $10 billion in Canada by the end of the decade. Shares in Arcellx are surging today. Gilead Sciences is buying the biotech firm in a deal valued at about $7.8 billion US. Gilead is paying $115 a share in cash, plus a potential additional payment tied to future sales. Gilead says the deal strengthens its cancer pipeline, adding a cell therapy for multiple myeloma. Gilead has been looking to diversify beyond its core antiviral medicines. And speaking of pharma, Merck is reorganizing its business, creating a separate division focused on cancer drugs as it prepares for sales pressure later this decade. The company's blockbuster immunotherapy drug is set to lose U.S. patent protection in 2028. The TSX slipping now from the record high it hit earlier, and we're also seeing some pressure on U.S. stocks amid fresh U.S. tariff uncertainty. It's not clear, for example, whether the U.S. companies that have paid well over $100 billion U.S. in import tariffs will get very much of that back. And interestingly as well, there is speculation that U.S. President Donald Trump may soon order large-scale airstrikes on Japan. For example, the State Department has ordered moving out non-emergency personnel at the U.S. Embassy in Beirut. Canadian banks set to report earnings starting this week. Scotiabank kicks things off tomorrow. Let's get some ideas on what to expect from Matthew Lee, analyst at Canaccord Genuity. Matthew, great to see you, and thanks for joining us.
Yeah, thanks for having me on.
You're looking for a pretty decent year for the Canadian banks this year, with earnings per share up almost 10%.
Yeah, I mean, look, the setup is favorable right now. If you think about the different factors that go into what makes bank earnings work, we have strong capital markets, strong wealth. We have credit that's remained relatively benign. Loan growth's not there yet, but overall, yeah, I mean, absolutely looking for a good year.
I guess the worry is always about possible consumer losses. What is your feeling? I mean, we are seeing some weakness in the Canadian job market, but you don't think provisions are going to be a huge problem?
No, I mean, I think you've probably heard this term before. It's a K-shaped economy, right? Mm-hmm. And for better or for worse, the banks are most levered to kind of the higher end of the consumer range. What that basically means is that until unemployment really starts to ramp up, or if it does, there's some protection there, especially on the mortgage book. Where we might see some pain is the credit card book. I think even in Q1, you could start seeing some impact there. But overall, again, credit's been benign. Most of the banks have guided toward downward sloping in the second half of the year. And I think 2027 might actually be even better.
Talk to us about Bank of Montreal. You say they have a pretty high return on equity. However, work is needed on their U.S. operations?
Yeah, their ROE is the lowest of the group, but it is improving. And so one of the biggest incremental data points that we got from the quarter so far is that they expect to be exiting 2027 with an ROE of 15%. Now, their ROE in 2025 was 11%. So if you do the math there, I mean, that just generates great earnings growth. And they can do it from a number of directions. U.S. banking, to your point, Andrew, that's a big piece of it, right? They're going to have to do a lot better in the U.S. in terms of generating wealth management revenue, reducing costs, rationalizing the footprint. But, Canadian costs, Canadian credit, those are going to be factors as well as the fee revenue we talked about earlier, investment banking, wealth management.
So you have a buy on Bank of Montreal. You also have a buy on Bank of Nova Scotia. You feel that the repair job or the restructuring at that company is doing well. They had quite a few years of underperformance.
Yeah, they've done a good job, and they've had great execution over the last couple of quarters. If I look at the international business in particular, I mean, that was something that a lot of folks didn't want to touch last year. It was an area of major concern. I think right now people are turning around on LATAM. Maybe it's going to be a growth area, probably not in Q1 right away, but over the next couple of years, that could be an outperforming earnings grower.
CIBC, you have a hold. Is that because of valuation?
Yeah, primarily. I mean, look, they've been executing great too. They've done a good job rationalizing costs, growing net interest margins. I like the way that they've been performing, but their valuation, they're not cheap anymore.
Why have investors been jumping in to CIBC?
To CIBC?
Yeah.
Yeah, I mean, you know what? Everyone likes a good execution story, right? If you're doing well and you're blocking and tackling correctly, in this business, investors reward you, and they should. They've earned every dollar that they've kind of improved. Their ROE's been great. Their Canadian banking operation has been very successful. To me, the biggest question for CIBC is where's the next leg of growth, right? They don't do international. They don't do the U.S. So it's a lot of Canadian exposure. For the valuation at this juncture, it's just not there for me.
And National Bank, also you have a hold. Do you feel the stock is relatively expensive?
With National, it's kind of the same story. Again, yeah, to your point, it is expensive. I think when I think about what I like in a bank right now, it's stories where the earnings growth is relatively easy in terms of, how you're going to get up, 10 or 12% over the next couple of years. So nothing against National. I think they've done a very good job, but a lot of their earnings in 2025 came from capital markets. To me, there is some questions around the replicability of that versus BMO, like I said earlier, where the steps are clear in terms of how you're going to get earnings growth.
Royal Bank, the aircraft carrier of the sector, you do have a buy on that one.
I mean, you can't bet against Royal, right? I mean, their ROE is great. Their ROE guidance is even better. And frankly, I think that they can outperform that this year. If I look at the kind of recipe that they've got, their wealth management business is the biggest. Their U.S. exposure is good. Their capital markets is best in class. I mean, it is expensive. Royal is not a discount bank by any means, but when you buy that, you're buying quality, you're buying execution, and I think they've done both.
What is your, and we'll just round it out then, TD Bank, set to go on winning back investors?
Yeah, I mean, it's been an incredible story over the last couple of years. We obviously had the anti-money laundering issue with TD. They came out of that. They apologized profusely. They invested in order to make sure their AML strategy was succinct and strong. They've restructured the U.S. business a lot. I think there's a lot of growth there. I mean, in Canada, TD banks 1 in 3 Canadians in some form. I mean, you can't beat that market share. In the U.S., they're a top 10 bank as well. And frankly, it sounds like the strategy is in the right direction right now. I think that's what people like.
1 in 3 Canadians, you said TD does business with one way or another?
Yeah.
That's amazing. Just finally, Matthew, I don't think you cover EQB, but could you give me your broad thoughts on them becoming a bigger competitor with the acquisition of PC Financial?
I don't cover it. I do believe that there's always a benefit to having a bigger, more scale bank. So, anything that helps you do that profitably is good. Again, I don't cover it though, so I don't really have a qualified opinion. on that one.
For sure. The government, as you know, in the latest budget made noises about increasing competition in Canadian banking, but my guess is anything will occur at a glacial pace.
Yeah, I mean, look, the Canadian banking system is very strong. We've done a very good job of managing through crises. We've protected the Canadian consumer. We've protected savings. Even, given the real estate market today, we're not panicking the way that they did in the U.S., over a decade ago. So I think you have to balance adding competition with, providing those protections to Canada overall. And I think the banks have done a really good job. And the other thing to say about that, too, the banks are competitive amongst each other, right? I mean, you talk to any mortgage broker, you talk to any retail banker, any commercial banker, they're out there competing every single day. So I don't think there's necessarily a lack of competition in Canada.
We'd better jump. Thank you very much, Matthew.
Sure.
Matthew Lee of Canaccord. Coming up, AI concerns and tools continuing to disrupt markets. We have 3 stocks that may be resistant to the trend. That's coming up. There are lots of fears that some businesses will be hollowed out by AI. Earlier this month, Anthropic announced tools to help automate legal and research tasks, and that helped to wipe billions of dollars in market value from software, financial data, and exchange stocks. Our guest has 3 ideas that he says will be resistant to AI disruption. We're joined by Julian Klimochko, founder and CEO of Accelerate Financial. Julian, great to see you. Thanks very much. It really is intriguing, isn't it, though? Lawyers, for example, they bill by the hour for work that a lot of it could, in theory, be automated.
Good morning, Andrew. Thanks for having me on the show. And you're right, there's a lot of fear and concern in the market with respect to really all of the innovations and developments coming out of the leading AI labs. And some of it is just truly exceptional. But as you noted, Anthropic will release a new model and hit certain segments of the market if investors perceive that they can be disrupted. So what we're talking about today is halo stocks. That's heavy assets, low obsolescence, effectively stocks immune to this AI disruption trade. And we're going to focus on sectors such as industrials, retail, and consumer staples. So we have 3 picks in those sectors to chat about.
Let's start off with your first idea, Toromont Industries, a dealer in heavy equipment.
Yeah, so Toromont Industries, TIH on the TSX, is a major Canadian industrial and equipment services company. So they serve segments of the market like construction, mining, infrastructure, refrigeration, and they're the largest authorized dealer of Caterpillar equipment. So this heavy machinery, not only do they sell it, but they also rent it and service it. So they really benefit from government infrastructure spending, electrification, broader economic growth. And fundamentally, it's a high quality business, return on capital north of 23%, recently beat quarterly expectations. They have rising earnings estimates, positive share price momentum, and get this, a 35-year track record of rising dividends. So what's not to like? Not going to be affected by AI, no disruption, but perhaps some benefit.
Your next idea is very different, Dollar Tree in the United States. Now, some of these U.S. dollar store giants have struggled. We hear about low pressure on lower income consumers, for example, but you like the look of Dollar Tree.
Yes, Andrew, and I've been on the show before, and I recommended Dollarama previously, another one of these low-cost discount retail chains. Now, Dollar Tree is one of the largest, over 15,000 stores in the U.S. and Canada. So they sell low-priced merchandise, food, household essentials. So they can do well in a kind of low-growth or recessionary economic environment, but also. And you mentioned kind of lower income consumers having a tough time, but you do have kind of higher income consumers starting to go there more and more with this persistent inflation. So they're really nailing the price point and poised for growth. They recently raised earnings guidance and beat quarterly expectations. So they're just knocking it out of the park from an operations standpoint. Attractive valuation, about 8.3 times EBITDA. One thing we really like is its capital allocation. For example, last year bought about 6.7% of their shares back. So reducing shares outstanding, attractive return on capital, north of 40%, and strong same-store sales growth. And get this, their expansion opportunities, they're talking about over 400 new stores per year. So it's still a growth story. And Dollar Tree, unlikely to be disrupted by AI. In fact, could be benefiting from it just via operational improvements, managing inventory, and location selection. So it's a name that highly unlikely to be disrupted, but in fact could benefit.
That's interesting. Yeah, I mean, presumably this will make it much easier for retailers to figure out where to put stores and what inventory to have. I mean, obviously they've been using big data for that stuff for years, if not decades, but AI will help them target certain markets.
Oh, certainly. And my third pick is along the same lines, Ulta Beauty, ULTA, largest specialty beauty retailer in the United States. So they're selling cosmetics, fragrances, etc. Over 1,500 stores, also a great growth story. They do very well in e-commerce. They're growing revenue, the top line, double digits, over 12%, strong margins, great same-store sales growth, and beating quarterly expectations. So they've been knocking it out of the park. And Andrew, even if AI ends up taking all of our jobs, we still want to look good. We still want to smell good. So these beauty retailers, I think, have strong growth potential. This one has a great free cash flow yield. Again, a consistent earnings growth, high return on capital, allowing not only reinvestment, but share repurchases, which we always like. They trade at a below market multiple, which is always nice. And lastly, you know, with a physical retailer like this, they really have their customers come into the store, try out their products, consult with an expert. And this is another name not going to be disrupted by AI, but perhaps benefit just through customer retention and things of that nature.
It's interesting, though. You may have heard there are some concerns that AI, when we're shopping online, AI will start offering us different prices according to what it reckons our ability to pay is.
Yeah, and perhaps a real sector leader like Ulta, I think, could benefit from that as they sort of consolidate the space and dominate the sector.
There are concerns, though, that it seems unfair to some people that I would have to pay less because, hey, they work out Julian has a higher income, he's been spending more. I'm going to hit Julian with a higher price. Bell gets away with a lower price.
Yeah, no, that could be a concern, but I foresee perhaps we all have internal AI agents who will protect us in kind of AI versus AI combat.
It's going to be interesting, as tools come out for consumers. Yeah. Julian, thanks very much indeed.
Thanks for having me.
Julian Klimochko, CEO of Accelerate Financial. Can we put up the intraday oil price? Because I think I made a stupid slip of the tongue on a very serious matter. There is speculation that, and it's simply speculation at this stage, that US President Donald Trump some kind of air attack on Iran shortly. And the Americans have moved a lot of ships and aircraft into the area. I think I stupidly said earlier, I've been told that I stupidly said he was talking about an air attack on Japan. So that's not happening. The American State Department ordering non-essential US diplomats to leave Lebanon. I was confused here because we heard earlier that fresh talks are heard between the United States and Iran on Geneva, or the talks set to resume later this week on February 26th, 3 days from now. But there is speculation that the Americans are going to launch some kind of an attack on Iran. Up next, one last check on the markets. The TSX did hit a record high and then slipped. On Friday, on Market Call, we were joined by Brianne Gardner of Raymond James. The topic, Canadian and US large caps. Her top selections were ATS, NRG Energy in New York, and Netflix. And today it's Jerome Haas, always worth listening to, portfolio manager at Lightwater Partners. He'll take your questions on Canadian stocks. Let's have a quick look at the markets before we go. You can see US stocks are now down. As I mentioned before the break, there is speculation that the Americans are poised for an attack of some kind on Iran. There are, of course, tariff jitters as well. And you can see, the S&P 500 down about 2%. Let me just see what the big traders in the United States are. Right now, we see Nvidia is holding up around $1.50. Tesla, though, down about 2%. Microsoft down about 2%. SanDisk is up about 5%. And of course, companies like that, makers of memory devices, have been capitalizing on a shortage of some of this equipment, although Micron is down. And let me have a look at some U.S. decliners here. Amex has come under pressure, down a little bit. Salesforce down again. My goodness, and people worried about the devastating impact potentially devastating impact of AI on some businesses. We don't know whether it's going to be corporate software yet. And Nike is slipping. Nike did go up initially when the tariffs were struck down on Friday and then gave up the gains. So I'm looking now. Nike was actually pretty flat on Friday, so I'm not clear why it's down right now. On the TSX, Shopify has come under pressure, although it and Amazon did rise on Friday on the striking down of the tariffs. You can see Shopify, down quite sharply now, down about 7%. It jumped, though, on Friday, but Shopify, let me just see how it's been doing this year. I don't think all that well. Down 27% right now so far in 2026. Let's pop up Lundin Gold here because it looks as though these financial engineering deals in which companies get better value for their silver production, they're spreading. So Lundin Gold has outlined a deal, a binding term sheet with an outfit called Lunar Royalties, which trades on the CBE in Toronto. The proposal here is for a $670 million silver stream for equity transaction. So Lundin Gold will sell the silver, or stream on the silver, from its huge Fruta del Norte mine in Ecuador in return for newly issued shares of Lunar. Now, it's all a bit inside baseball here because Lunar's CEO and chair is Adam Lundin of the Lundin Group. The plan here is to build a portfolio of royalties and streams without the capital or operating cost risk borne by traditional miner companies. And so Lundin, that's interesting, wanting it both ways here. They're offering they've got a financing vehicle in the form of this Lunar Royalties, which is an affiliate of them. We don't have the chart right now on Lunar Royalties, but it's been doing pretty well. It already has a couple of royalties out there, but this, of course, is like Randy Smallwood's deal just last week, Wheaton Precious Metals, taking a silver royalty for more than $4 billion US on that huge mine in Chile. And speaking of precious metals, you can see gold up today, up 3%, and silver, always volatile, and it has jumped almost 5%. That's interesting, though, with that Lunar Royalties deal, that Lundin getting in on the act of the streaming companies and setting up its own stream. Thanks very much indeed for watching our show. Morning Markets is up next.